A decision by the Nairobi Securities Exchange to suspend trading of Kenya Airways shares brought to an abrupt halt a meteoric rise of its price in the last 2 days. According to NSE data, the KQ share posted the highest trading rise in the week by 40.81% to 3.83 shillings, up from 2.72 shillings. Faizal Ahmed reports on the move attributed to the publication of the National Aviation Management Bill.
Rising by over 40% in price, the Nairobi Securities Exchange on Friday suspended trading of Kenya Airways shares. The airline had only this week alone traded 12 million shares, a significant move from its previous trading. In a statement, the NSE said that the 3-month suspension was in line with the publication of the National Aviation Management Bill that sets the stage for the carrier's delisting and subsequent nationalization. The bill published last week had drawn attention to KQ shares. On Wednesday, it had traded 7 million shares on an improved price of 3 shillings and 83 cents per share.
For Kenya Airways, we have seen speculative trading activities on the counter, with the price nearly doubling in the last 1 month up to yesterday's close of 3 shillings and 83 cents. We think that the acquisition price will determine whether these investors are in the money, with their estimated acquisition price of around 4 shillings 88 cents per share to be paid out to the minority shareholders.
The moment that bill was published, trading in those shares should have been stopped at that point, because now we're just having speculators, people who are hoping to make a killing in that buying the shares now, so that by the time the bill is debated and the whole process is over, then they will make a significant profit. Yet they were shareholders for only a few days.
Published last week, the Aviation Management Bill seeks to take back control of KQ to the national government under the new Kenya Aviation Corporation. The bill, Moniki, an aviation expert, says still has flaws.
The bill does not address how day-to-day management of the airline will be managed, and more so how there'll be a clear separation between the government owning and management. So,
under the new arrangement, the National Treasury will put in some 6 billion shillings in fresh share capital. It is, however, silent on how the airline, currently debt-riddled and weighed down by losses, will overcome these challenges.
What Kenya Airways requires is a complete intervention. Small and piecemeal interventions, as it might say, will not be enough to assist the airline.
Other analysts have also indicated that the rebirth of the airline will need more than just nationalization. This, they say, will have to include a review of strategic ideas and arrangements entered with the airline in the last decade that has mostly been attributed to its woes and bleeding money. Meanwhile, the airline has announced staff rationalization plans. CEO Alan Kilevuka, in a memo to staff, says that the decision is as a result of low business due to the ongoing COVID-19 pandemic. Faizal Ahmed, Citizen TV, Nairobi.